While the recent bounce in sales activity has brought back some optimism and shelved the idea of a market crash, let me make this clear. This is by no means a healthy market. Activity is all over the place. Some product is selling extremely well, and others not so much. We are seeing spurts of multiple offers and lots of other places going no bid. Navigating the market has never been trickier. Although, let's be honest, this should not be surprising. We are still in the middle of a once-in-a-lifetime global pandemic, and officially in the deepest recession since World War II. Kudos to policymakers who have managed to suppress much of the pain via 743,000 mortgage deferrals and CERB checks for over 8 million Canadians. But wait, there's more. A temporary halt on tenant evictions, consumer insolvencies, and foreclosures. This has arrested economic gravity. As I've stated numerous times, it's likely smooth sailing like this until summer is over, and we can get a better read on how policymakers decide to deal with the mortgage deferral cliff in Q4. However, keep in mind that in BC, the foreclosure process is extremely long and drawn out. From the time a borrower misses a payment till the time the house is sold via court order can take upwards of 12 to 15 months. In other words, foreclosure sales likely won't peak for another couple of years. Again, policymakers are doing everything they can to support the market and prevent prices from dropping. And so far, they're doing a great job of destroying free market price discovery. The Bank of Canada's balance sheet has more than tripled since March, including over $8 billion worth of Canadian mortgage bond purchases. This has pummeled the mortgage rates into the floor, with 5-year mortgage rates now in the low twos, and clearly those who still have jobs are taking advantage of this incredibly cheap money. Long story short, it's much too soon to declare any direction for the housing market. We are in a world of uncertainty, and I suspect that will continue for the rest of the year. Stay tuned. Now, detached home sales across Greater Vancouver, those have bounced 16% year over year on a year-over-year basis in June. However, when you zoom out, it leaves much to be desired. Sales volumes remain chronically low, but then again, new listings remain benign. While they've increased from last year's levels, they remain well below normal. Basically, it seems like nobody is selling their houses. As new listings remain low, inventory for sale is not building. Despite the economic downturn, in order to see lower prices, you will need to see supply build, putting some pressure on sellers to reduce their prices. As of the end of June, there was just 4,000 detached homes for sale, and that is the lowest total for the month of June in over a decade. In other words, all the commotion you're hearing about in the detached market and how it's being really hot and a bunch of houses going into multiple offers, this is not due to a frenzy of buyers desperate to get in, but rather very few listings means buyers have very few options. For detached houses under 2 million, there is only 4 months of supply for sale, and that is considered to be a very tight market. And if it holds at that level for several months, it could actually put upward pressure on prices. Hard to believe, but I don't make the rules. Obviously, under these conditions, detached prices remain firm. Move-in ready homes under 2 million are selling quite quickly. Condo sales, however, were not good. Condo sales increased 17% year over year, but keep in mind, June 2019 was a 17-year low. In other words, despite incredibly weak base effects and some pent-up demand from the spring market, we were left with a rather lousy rebound. Unlike the detached market, new listings surged in the condo market. There was clearly some pent-up demand from the spring market. New listings for the month of June rocketed higher to their highest levels since 2008. It's likely partially influenced by investors and Airbnb hosts dumping some of their product. Total inventory for sale is clearly building, and although it's still quite a bit lower than last June, inventory will need to continue to grow to see downward pressure on prices. Months of inventory for sale in the condo market sits at 4.6. Of course, this will vary by price point and by location. The hardest hit area today seems to be downtown Vancouver, as there appears to be a migration happening while migration outwards towards the suburbs, as people seem to think that they'll be working from home for an extended period of time. As mentioned last month, there appears to be some price discounting in the condo market, although there's a lot of volatility and it's becoming increasingly difficult to map an exact percentage. The average price per square foot today is showing very little change at the moment. By the way, have you heard the much talked about Strata insurance crisis is ramping up? Strata buildings renewing their insurance are being hit with significant levies as insurance companies adjust for what they are citing as an increasing number of claims and rising repair costs associated with those claims. As a result, per the BC Financial Services Authority, insurance premiums have risen an average 40% across BC and a staggering 50% in Metro Vancouver. And that's not all. Insurance deductibles have skyrocketed higher, tripling in some instances. The largest increase appears to be hitting high-rise condos. As a result of all this, we're seeing stratas react by raising small special levies to cover the increase or raising monthly strata fees to offset the costs. Overall, this is a further blow to the housing affordability and something the BC Financial Services Authority is calling unhealthy. On June 23rd, the BC government announced several policy decisions to try and mitigate the damage. The government aims to end the charging of referral fees between insurers or insurance brokers and the property managers or other third parties, as well as require the disclosure of commissions. We heard the commissions could have been up to 20% of the cost, said Finance Minister Carol James in a press conference. In addition, the BC government is encouraging strengthening depreciation reporting requirements, including a limit to the use of loopholes to avoid doing the reports, and changing the minimum required contributions by owners and developers to the Strata Contingency Fund, strengthening negotiation requirements to the Strata insurance coverage and costs. Still, make no mistake, this will do very little to solve the crisis in the private insurance sector. It is believed that the BC government is working on further measures to be announced in the fall. Regardless, both homeowners and prospective buyers should be factoring higher strata fees moving forward. Now, the central banks. They are working around the clock to flood the financial markets with liquidity and suppress interest rates from rising. Indeed, central bank balance sheets have ballooned to new incredible heights, going so far as to purchasing just about any kind of debt they can get their hands on, including corporate junk bonds. The Bank of Canada has joined in on the party in their first official foray into quantitative easing. In essence, these purchases help create liquidity for the banks by clearing up the balance sheets, and this allows them to continue lending and issuing new mortgages, while at the same time helps keep mortgage rates from rising. Mortgage rates are hitting all-time lows right now, and you have the Bank of Canada to thank for that. Although, it certainly brings up a discussion surrounding the moral hazard. The intervening in free markets by not allowing interest rates to come even remotely close to rising provides a backstop on housing prices. This encourages further speculation, as investors feel they will always be bailed out. As I've said before, interest rates will remain lower for longer. And the new Bank of Canada Governor Tiff Macklem signaled the same just as much in a recent press conference, where he said, "For now and into the foreseeable future, we are focused on providing monetary stimulus and delivering low interest rates to support the recovery. We have no intention of raising interest rates in the current circumstances." Mortgage deferrals appear to be holding steady. Per the Canadian Bankers Association's 743,000 borrowers received a referral, which accounts for about 15% of all mortgages outstanding. The big six banks have now deferred over $300 billion worth of loans. This is certainly a concerning number, even if a good chunk of these borrowers don't really need the help. Meanwhile, the two largest non-prime residential mortgage lenders, Home Capital and Equitable, reported that 30% of their non-prime residential mortgage book was granted mortgage deferrals. Most of these deferrals will expire in Q4 of this year. As such, we will see an increase in the number of foreclosures in 2021. Keep in mind, the foreclosure process does not happen right away. Typically, big banks will work with borrowers when they miss a payment. Usually, if they miss 3 consecutive payments, the bank will then begin the foreclosure process, which can take over a year. So that's June. I know it's a lot. Reach out with your questions. It's Realtor Josh Kepke here. I want you to reach out with questions, subscribe, follow, and comment below. And you can always reach me direct, 604-313-9805. Take care. Bye for now.